Hello, I am John Najarian, and RebelCon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at RebelCon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
And happy Friday once again, Market Rebels. Another nice little rally in the markets. I didn't see the actual close, but I think we were up about 1.5% or so on the SPY. So again, kind of these topsy-turvy markets, but it really shows the importance of options because options thrive in volatility. But it also means that you have to understand what makes an option tick and what makes a strategy tick. And so I thought what might be a nice topic to talk about today is the three different types of at-the-money. We often hear when most people talk about at-the-money options, they'll say, well, it's where the stock equals the strike price. That is a definition of at-the-money. It is not the definition. And I think this also shows the importance where a lot of times people learn one definition and they think that it applies to everything. And then they're wondering why their strategies aren't working out. So let's take a look at the three different types of at-the-money options, and then at the end I'll show you a specific example why this is so important. So the first one is that the basic one that I mentioned is where the strike equals the stock. And so if we have the stock trading for 100, if you're looking at the $100 call or the $100 put, we would say it's at the money. Now, in the real markets, it's pretty rare that you're going to see it trade for exactly the stock price. So the general practice is that it's the strike that is closest to the current stock price. And we would call that the at-the-money option. And this definition of at-the-money is where the option holder, the person who buys the option, is indifferent to exercise. So think about it. If you have the $100 call and the stock is at 100 at expiration, you could let the call expire worthless, pay 100 for the stock in the open market. Doesn't make a bit of difference to you. You could also exercise and pay the 100. That's what it means to just be indifferent. Doesn't really matter, but that is the standard definition of at the money. So here we go. If we look at where the stock equals the strike, now you'll also notice I have this set to European style. For the equity markets, for all of the stocks, it is American style, which means you are allowed to exercise early. The reason I do this to set things to European for a lot of the pricing principles is because it blocks the effect of early exercise. European style options cannot be exercised early. So there's a little bit of value, not much, but a little bit of value for being able to exercise a call or a put early. And we want to eliminate that from the analysis. So that's why I've got it set to European. But if you notice, we have the stock at 100 and the strike at 100. All right, so those are equal. But notice over here on the right, the prices are different. The call and put prices are different, and the deltas are different. What else do you notice? That the difference between the call and the put is $4.76. That's just this 1033 minus 557. But look at that delta. Doesn't that look a little odd to you? It's 63 delta. Aren't we usually told that the at-the-money option has a delta of 50, or at least close, 52, 53 maybe? Certainly not 63. So why are we getting a 63 delta for an at-the-money option? All right, so that's the first clue that things aren't probably the way that you thought. The options aren't working the way that you would normally expect. Now, here's another look at it. Let's keep the stock equal to the strike. I'm going to put volatility at 1%. Now, don't ever expect the volatility in the markets to be at 1%. I'm doing that just to mathematically mean that the stock can't move. So think about it. If you have the strike at 100 and the stock at 100, now I do have a 1 year till expiration. I've done this to make some of the math easier when we start looking at interest rates. But you would think that that means that the option would basically be worthless if the stock really isn't allowed to move. Well, why is the call 476? See, the put's worthless, but the call's not. The call's far from worthless. Also, look at my call's delta is 1. How could I have a delta of 1 when the stock equals the strike? See, so these are some of the puzzles that start to throw traders and cause some of the misperceptions when they start putting on strategies where this knowledge is required. So these are some of the issues. We'll come back to these in a moment when we're looking at the standard definition of at the money. Now, where this is coming from with this 476 is that if we have let's say $100 at 5% interest in a bank, that would be $5 worth of interest. Remember, this is a 1 year option at 5% interest rates. In finance, we can look at what's called the present value or today's value of the interest. So we're going to take that future value. In other words, we're going to receive $5 from the bank, but it's not going to be until a year from now. Well, what's that worth today? Well, we would have to just back it out. We have to say 5 divided by 1 plus the interest rate, or 476. So in other words, if you deposited $4.76 into a bank paying 5%, it would grow to $5 in 1 year. So that's called the present value. And there's an option pricing principle that says that a call option has to trade for at least the present value of the exercise price. And that's why this has this price. It's not because of volatility. See, volatility is basically at 0. This is from the cost of carry. So this is another issue that traders run into. They might be selling options that have a very high cost of carry. Think like when Amazon was trading for 3,500 or 3,700, whatever it was before the split, and you're looking at a 1.5 year leaps option. It can look like a super, super expensive option in terms of the volatility, and a lot of that was just the cost of carry. And so it might not be as appealing of a strategy once you know what to take into account. All right, so these are some things that are showing us that our standard definition of at the money seems like it's not quite complete. Again, we've got a delta of 1. We have an option price of 476, even though we have virtually no volatility. All right, so we're going to come back to that in a little bit. But it's because of these issues that in the academic world, we look at what's called an at-the-money forward, which is a little different definition. And with this, we are looking at the strike equals the future value of the stock. So if we have a stock at 100, and let's say the interest rate again is 5%, we have 1 year, the at-the-money forward option would be the 105 strike. Again, that's just assuming that you deposited $100 into a bank paying 5%, you'd have 105 at the end of the year. And so this is actually the way that the Black-Scholes model sees the at-the-money option. It's what's called the forward price or the forward strike. Now, most of the time for short-term traders, and in today's world with virtually still, not 0, but still pretty close, and a 30-day option or something like this on a $50 stock, it's not going to make a bit of difference, maybe a penny or so. But you start getting into the more expensive stocks and going out in time, and this will absolutely become an issue for your strategies. So notice what's happening now. We've got a different strike from our stock. But what's going to happen with the at-the-money forward is that the call price will equal the put price. And there are times that we might want that to happen. You can't use the standard definition of at the money. So take a look what we've done now. The stock and strike are no longer equal. We've got a 100 stock and a 105 strike. All of the rest of the information is the same. But now the prices are equal. Call and put prices are equal, but the deltas are different. We've gotten closer, but they're still different. And what you're going to find as I go through these examples, we're either changing the stock and the strikes are either going to match or not match. The prices will or will not, or the deltas will or will not. We're just looking at different combinations. And it's something that most traders never even think is an issue. All right, so there we can get our call and put prices to equal. Now let's take a look at the third type of at the money. And this is called an at the money delta neutral straddle, or DNS. Okay, so that's what that stands for. And when we look at an at the money delta neutral straddle, it means that the call delta equals the put delta. See, before we saw the prices were equal, now we're going to get the deltas to equal. And what we have to do here is we have to add the interest, we have to account for the interest, but we also have to add a correction factor for volatility. I'm not going to get into the details of why this is, but that's really the essence of what's happening. So in this example, we have 5% interest, we have 20% volatility. The correction factor is I need to take this volatility, 0.2 squared, which is just 0.2 times 0.2, which is 0.04 divided by 2 would be 0.02. And what that means is I have to take my interest rate of 0.05 plus this correction factor of 0.02, and that gives me 0.07. So you can think of this as saying that it's effectively a 7% interest rate, and we therefore would need a strike of 107. So if I do that, take a look what we've got. Now we have the stock and strike are not equal again. Stock is 100, but we're looking at the 107 strike. What happens now? Now my deltas are equal, but the prices are different. Okay, see, it's just the opposite. Last time we had the prices equal and the delta is different. Now I can flip them. But in order to do that, I have to add this correction factor. All right, so the main thing that I'm trying to show you here is that there's a lot of moving parts with options, and it's the intricacies that you have to understand. If you're putting strategies on and they're not working out the way that you might have thought, this is probably why. You need to understand what makes it tick, not just the definition of a vertical spread or a straddle. You need to understand the things that are absolutes in options trading. So here's a good example of why this is important. Let's say that we have where the stock equals the strike. Let's go back to the initial at the money definition. And we buy the call for 1033, the put for 557. Look at our deltas, a little bit off. They're not equal. But if we did a straddle where we buy the call and the put, the textbook definition is you buy the at the money call and put. Well, somebody who didn't know better would say, let's buy the 100 call and put. Stock's at 100. So this would be our deltas right here. We've got a 63 delta minus 36. See, we've got a 27 delta. And if you're trying to do a straddle, what you're saying is, I don't know which direction the stock is going. You want delta 0. You don't want delta 27. That's leaning to the bullish side. And yet this is why so many people get burned on straddles, whether long or short. So here's your expiration graph for the straddle. Just looks like this V. And you would think that the current curve normally would kind of sit inside of this V. But look at what it looks like. Okay, so you think that you're right here, but this is your current curve. Look at that. That's very different from what you'd expect. There's this kind of this tilt. Now, the reason the red line sits below the black over here is, remember, we're looking at European style options, and so you can't exercise a put option early. So this is the only time where an option could trade below intrinsic value prior to expiration, and that's why that red line dips below there. But look at the difference in the slope. If you want to get to delta 0, you need that stock to be at 88. That's 12% below where the current stock is. So think about this. If you buy the at the money straddle, or what you think is at the money, you're leaning to the bullish side, but let's say it starts to fall. It falls all the way down here, and what you're doing is losing money. And it goes all the way down to 88, and guess what? You haven't made a single penny. You don't have a single delta in your corner. It's only when it gets way down here that you'll even start to show some sense of a profit, and that throws traders. They don't understand why that's happening. So I just wanted to run that by you for a number of reasons to show you that there really are three basic or three kind of key definitions of at the money. But probably more importantly is I think it shows the importance of understanding options and not memorizing them. So for anyone who'd like to better understand options, we'd like to invite you to have a free consultation, have a free chat with one of our world-class coaches. You can contact them at 809-8058. Just tell them you heard it here, that you want a free one-on-one assessment. They'll chat with you about anything. If you want to talk about strategies you're doing or ways that you can hedge different strategies, outlooks that you have, they can always add tremendous insights and things that we're trying to show you here as well on Trading Tune-Up. So please give them a call. And I want to wish everybody a very good weekend coming up. And for all of the market rebels, remember, we do have cocktail hour at 5 p.m. Eastern. So have a great weekend. We'll look for you on Monday with our next Trading Tune-Up. We'll see you then. Thank you.